I definitely won't mention this investor's name, but they rang us and put us on a conference call with, and we've been on this for 6 months probably with them, put us on a conference call with that customer, said, very sorry guys, got to the last minute, I'm afraid we've changed our mind on Italy, we're not here to do that anymore, our investment committee have turned it down, thanks very much, but and you just feel the blood kind of draining. And we often get asked, what's the biggest risk in this project by capital or new capital, or and Christoph and I's response is probably the capital is the biggest risk in all of it, I think, from our perspective anyway, which is interesting because they don't usually perceive it that way. For the investors, they got a 22, 25 IRR. We return them their 190 million facility plus 130 million euros of profit.
Wow. James, welcome to the podcast. So a place that I always like to start these conversations is how and why did you get into real estate? Because I'm excited to unpick Logistics Capital Partners later in our conversation, but to start, can we go back to chapter 1 and can you tell me a little bit about how and why?
How and why is probably a bit of a long winding story, but to try and pick in some important moments. I had an uncle who was in property, but I had no real direction when I was younger. And it was only when I was thinking about going to university, he said, why don't you consider a real estate degree? And no one, or very few people from the school I went to had that as a career path. I actually switched from doing a history degree at Edinburgh University, having already kind of got the place, to doing real estate at Reading. I went to Winchester College, a private school for boys, and I think they all thought I was completely mad. It just wasn't in the normal pathway for most of the people there. They all went off to Oxford and Cambridge and all became lawyers and bankers and all that kind of stuff. I was going to say,
because Winchester is a top boys' school.
It is, yeah.
It's quite very academic.
It is, yeah. It's all of that. I managed to squeak in. And I think that's probably another part of it, but maybe I'll touch on that later. But it was an unusual path to go and do that, but that was down to my uncle. And I basically became quite kind of pragmatic as opposed to academic or in search of kind of a history degree. And I'd worked in my gap year actually for Rothschild Bank in the research department. But what that actually meant is I basically went and retrieved files from archive and brought them up to the analysts. I didn't really do any work. But from that, I got a sense of the city, got a sense of commercial things and decided I wanted to do something in that area, which point he kind of tapped me on the shoulder and said, there are other ways about getting qualified and having a degree and doing something more vocational. So I went into it, but aside from him, I didn't really have any contact with property, didn't really know what I was getting into at all, didn't know the course. I knew Reading was good. And I think most of my mates at the time just thought I'd kind of completely lost the plot, to be honest.
What were you like growing up as a kid?
I was completely unfocused. Like sport, obviously did well enough to, as I say, to kind of squeak into Winchester College. Was reasonably kind of outgoing, but had no real idea or agenda of what I wanted to do. So I was probably looking and needing someone to sit me down and say, here's a direction, and then kind of grab onto it.
What did your parents do?
My mum was a physio. My dad was a GP down in the New Forest. So aside from my uncle, who was a lecturer, and then he was on the HR side, in the recruitment and training side at Hillier Parker, as was. So he had a good idea of candidates and things like that, and also had a good understanding of the real estate market, having lectured at Oxford Poly, I think it was at the time. But we'd never really discussed it. I'd never really considered it. And he got me into it and got to Reading, loved it, got a place out of that at Hillier Parker, as was, after doing several years of work experience. And that was just at the stage in kind of 2001, I guess, when the big US agency firms started up and these mega mergers between the agencies happened. So you went from Hillier Parker, I don't know, kind of top dozen surveying firm, to what became CBRE, number one, globally in London and all the rest of it. And that kind of happened around me right from the start, really. It was an incredible time.
So you joined the graduate scheme, right?
Joined the graduate scheme, yeah. you move around as your graduates. I had I've definitely had highs and lows as I've kind of gone through it. Going back to Winchester College, I think because it was so highly academic and so competitive and it was all boys, the plus side or the downside is that that's quite hard, environment. If you had a B in your A levels, you might have had 2 A's, but you got a B. I mean, you were generally regarded as special, almost having special needs. It was that kind of level. Everyone went to Oxford and Cambridge. So the downside is it was quite intense from the start. The upside is you got to know intrinsically intelligent, scholarly people who you can identify on your way through the rest of life. You sort the kind of bullshitters from the real intelligence, and you can spot them a mile away if you've kind of lived in that environment as a teenager. So in terms of where I did my graduate rotation, I think we're talking, and I wanted to allude to kind of highs and lows, and graduate rotation had a bit of highs and lows, and so did my kind of schooling as well at Winchester College. And you have kind of easier placements and you have harder placements. And one of the defining placements for me, which was actually one of the hardest ones, I spent a year in the city investment team. I was completely ill-equipped to deal with it. One, I hadn't really got into the stage of getting focused on what I wanted to do and it as a career. It was all just an easy ride for me at that stage, and just thought everything in life would be nice. But city investment team at CBRE was a high-end business with very focused, very diligent, hard-working guys that just didn't tolerate any slack in the system. And I was in there as an analyst, having to do numbers, which again I'd kind of glossed over or just taken an easy ride through up until that point. And it was a proper year's beasting. And whilst it was really hard and quite long hours and weekends and kind of getting picked apart, that then gives you a really solid foundation, because after that everything seemed relatively easy. So thank you to those guys, and you know who you are, for giving me a seriously hard time, because it's you have to have that in order to kind of go on and succeed, and you can't hide from it. You've got to address it at some point.
And so was that city investment your first rotation?
I think that was my full second year. And whilst it gave me a good foundation, I definitely thought I'd like to go and do more investment agency and have a bit more of the ability to go out and do the brokerage and the relationship forming, the contacts and deal trading and sharing and all that kind of stuff, rather than being locked in a spreadsheet and beasted 7 days a week pretty much. So I quite quickly after I qualified rotated and got a job in the national investment team at CBRE, which after the city investment team felt a lot easier, a lot more social. And there was much more scope for a junior recently qualified person to go and kind of spread their wings into the type of agency and investment agency and brokerage bit, and actually try and do your own deals. And that was a kind of a breath of fresh air at that point. It's also, as it happens, where I met my wife, but that's another story. That's a different story.
In terms of the career path that you could go on at that particular stage, was it investment? Was investment definitely the route you wanted to pursue, rather than valuation, property management, L&T, leasing, the other parts that you would have been exposed to by proxy of being in such a large organisation?
Yeah.
Because?
Bluntly, I when I selected to go to Reading and pulled out of what was otherwise considered as a traditional university academic and career path, for the rest of my peers, the reason for doing it was to go and do the first kind of branded investment and finance degree in real estate degree that Reading offered. It was the first year they did that. So I was one of the first in that, for that whole program, which changed it from just being a land management degree. And it had much closer links to the business school, and it had modules for that. So there's a kind of clear reason for that. And it kept your options open for other finance related industries effectively. So yes, that was always quite clear. And then in my work experience during that time, I did 2 summers during university when I worked at what was Hillier Parker's investment management business. So that was fund management. So I always had that bent, always wanted to be in the investment team. And so as a graduate, I guess the one area I was focused on is, if I'm going to do this, that's where I want to be. That's where the money is. That's where the trading is. And it was kind of all in for that. So I was always pretty vocal and clear to everyone around me. That's where
you wanted to be.
Yeah.
And I guess 2001, you know, the types of capital entering in the market, you know, private equity and, you know, a bit more rigor when it comes to financing and structuring and analytical need, you know, married at a perfect time?
I'd love to say that I was strategic and I knew what was going on at that stage, but I think I was just happy to kind of be there and be given assignments and help work up properties and help assist those that did know what was going on and knew the shape of capital. That side of it I really didn't understand. I mean, subsequently I spent 14 years at CBRE doing investment and led a pretty good team at the end, so obviously morphed into it. But 2001, you're just kind of working out, you know, what's a sale, you know, how do you put investment details together, you know, who do you call and how do you make this kind of work and how do you be helpful. I would say it was a bit later, in 2005 and 6, I started to actually do my own transactions. And that got me noticed by, and that was also a period when the big firms had done their kind of mega mergers, and then they started buying top quality niche firms like the guys from Holly Blake, as was now DTRE and Simon Blake and Simon Holly and those guys. And also a whole range of other niche firms into retail, city investment, West End. All the big names and players were getting bought up by CBRE at that point. And I think it's at that moment you start to get insight into the different investor pools, different sorts of capital, private investors as well, development funds, and the big developers. And I became more industrial focused, and that's also when I met kind of Simon Blake and David Turner, and we ended up in 2007, I guess it was, after they'd been bought in and Blake had been given a mandate to create a pan-European investment team for logistics. I ended up being kind of getting noticed, I suppose, and being his bag man effectively. And our first sale was a big sale for Prologis, and it happened to be the largest industrial sale ever in Paris or in France at the time. And that was really a pretty great way, with all of their experience and track record, then running this sale to launch that team. And it was the first pan-European logistics brokerage team that really existed, was organised, created, galvanised and coordinated, and had the full company's kind of focus behind it. So it was an amazing time and privilege to be in it. And it gave me a massive jump in my career, bluntly. There's no two ways about it.
So before that, you were doing multi-sector UK transactions. You've done the analytical piece. Anything
that I could get my hands on, give or take. You had an arrangement where you had the senior partners of firms, but you also had junior brokers. It probably still works a bit like this as well, trying to do favours and trade information and you know, bring in early and try and get it placed and hope that, you know, capital partner a capital or investor on the other side would recognise that introduction. So it was throwing lots of mud at the wall, hoping something sticks, trying to pull something together, but definitely not so strategic and focused. But it gives you there's a lot of competition around it. You have to be really resilient, really persistent, you know, take just knockback after knockback after knockback, but you've just got to keep ploughing on. And you also meet a huge number of people trying to work out how to get it to stick. So you can't change those hard yards. And there are a lot of people who just get frustrated and just think this is bullshit and go off and do something else. But I think if you can tolerate that, believe in it, it really does open up a lot of areas, people, companies, businesses, insight. And then, you can launch yourself into some more senior positions and interesting stuff, I guess.
So over and above what you've just said, why do you think you were picked in terms of that kind of newly formed pan-Euro logistics transaction-focused role or team over maybe some contemporaries of yours?
That's
what were you demonstrating? What were you doing that we want James Markby in our team?
Oh, that's an embarrassing question. In my mind, I think I was eternally enthusiastic, basically. You know, I was just keen to, you know, do anything for anybody. So just permanent enthusiasm. Was on the edge of some transactional activity that I generated myself, so wasn't just processing other people, so could stand on my own 2 feet to a certain degree. I probably other people maybe in front of me were kind of successfully ensconced with their own client base, and anyone slightly junior wasn't useful enough maybe, and I kind of filled a good middle gap. So there's a little bit of kind of chance and just being in the right kind of profile, junior enough but not, you know, not too senior. The other guys who came across from Holly Blake, I think, you know, were all very successful in their own with their own client base, and so they didn't want to take anyone out of distracting from that. Entertainingly, I think Simon Blake, who I think, you know, he gave a bit of work out to different people, and I'd got this development project which off a private client of his that you know, I had to go and kind of get the funding for. And he watched me for weeks struggle through this development set of heads of terms for funding it, and, you know, every 5 minutes, I've got another question. And I think he liked the fact that I was kind of open about what I could do, but also what I couldn't, and could see me kind of grinding through it and wrestling with this thing until we got it done. And actually, as it happened, the capital that was introduced to it was actually someone I knew, and it was just as Goodman were coming over. In fact, it was one of their first transactions into the European market, and I'd picked up on that. And I think I like to think he thought I had an instinct for it, and kind of it was worth giving me a shot.
So you did that deal with Prologis in Paris, the largest at that time.
Yeah.
What did the next few years look like for you? And just talk me through some of the deals you did.
Well, that would have been 2007, and that transaction sold literally just before Lehman's. I think by the time it had been marketed and sold. So we went from a crazy boom period. I've seen other people talk about, everyone knows about that period, and free debt effectively, and more leverage than equity in some transactions. You had big US agency firms coming over buying agencies. You also had big US developers coming over. People were building platforms and footprints on a global basis, massive amounts of capital. So it was a great moment. I mean, as a young bloke, you don't know how good you kind of got it. Then the crash came. And whilst that was concerning, we were kind of onto a great new thing. It was kind of logistics, large scale around Europe. There was demand for that. People hadn't really coordinated it in the same way. So whilst there was this concerning crash around us, there was actually loads of good new interesting business to get this whole initiative off the ground. So we went on a really quite nice run anyway off the back of that, and had some good credibility from the good time and some major sales. It was a nice kind of calling card. Simon then left around, I'm going to say 2008, 2009. David Turner then took over for a year and left in about 2009. And basically I was the only kind of guy left in the team who'd been doing, bluntly, you know, all the work, carrying the bags, putting the portfolios together, knew the ins and outs of who was trading what. And I think they looked at me, and I would have been probably just shy of 30, and the senior team were like, well, you are too young to have this particular role, but frankly there's no one else left who's been doing this. You're in all of it. You've got a year to kind of make it your own, and if you do, you can kind of have it, and if you don't, well, we tried, but you know, we'll have to do something about it. So yeah, from about 2010, I guess 2009, 2010, I got kind of head of European logistics investment at CBRE, and I ran that till 2015. And it was just a great time. We even in the downturn, we then started, because of the machine that CBRE is, you'd be put in front of banks, you know, so all the equity positions were gone in some things, and you were into banks who were trying to protect their loans. We were doing large loan book sales all around industrial, or you're brought in to advise on that line of the entire book. So in that sense, the reshuffle of the market, a bit like what's happened over the last 12, 24 months, that reshuffle of the market and all the known lines of communication and information and value and all that, all thrown in the air. So if you've got a big machine and network around you, and you're given a senior role, and all of those historic lines have been manoeuvred and fractured, there's just loads of areas you can go into, have credibility, and start unlocking stuff. So for me personally, whilst it wasn't a great time for lots of other areas and people and sectors, my personal growth was just massive through that period, and we just got more and more sales. So by the end, we were I think in that 6 years, we had a 30-40% market share every year of every logistics building traded in Europe. We were doing hundreds, if not billions a year. And that's when the market probably in total in 2009 and 10 was, I don't know, of logistics, 8 or 9 billion a year. And then it went to, 12, 15, 20 billion. And we just rode that market share, so you end up in 2015 with just this huge contact book, a massive amount of experience across all these markets, and just a massive volume of stock you've seen and traded, and you just know where everything is and where to go fishing and hunting, basically.
And that's everything from acquisitions, disposals, kind of working with developers, investors, private equity clients, single asset, portfolio deals, the whole big box, multi-let, mid-box, or...
It was the whole thing. The light industrial bit, I got heavily involved in, because that was the bit that had felt the most pain post the GFC or during the GFC. So it was the quickest to come to large portfolios at serious discounts where the banks needed to protect their positions or needed to be recapitalised. So 2008 and 9, that was the stuff that started coming out at scale. So then the big PE groups that wanted to form new portfolios and the operating partners that had been partnered with them previously all came in to start buying. And bluntly, it wasn't necessarily ability, but a lot of people, it felt like a lot of people wanted to know me because of the pipeline of transactions that we could, I could facilitate from being within CBRE. So it was a really privileged time. I mean, it's been a reality check since. Once you're outside of that and you're no use to anyone anymore, you have to really build up your usefulness before people return your calls again. But at the time, it was great.
We'll come on to that because money talks, and when you've got a decent balance sheet, people end up finding you. So you were with CBRE until April 15, senior director, head of European industrial and logistics investment at that stage.
Yeah.
Early 30s.
Yeah, 34, 35 at that point when I left.
You touched on earlier, you met your wife at CBRE?
Yep.
Married?
She was my boss. I had to work very hard to get out of her team. do something else. Another reason I wanted to do European, because she was in the UK investment team. And I thought, if this is going to work, I can't be in the same team as you. Anyway.
So, married at that stage?
No. So we've known each other for 20 years. I'm married 7 years ago. In fact, it was our anniversary yesterday.
Oh, congratulations.
Thank you.
So what was it that prompted you to leave CBRE? You were at the nexus of the market, leading team, commanding 40% of the transactions.
Yeah.
A lot of tailwinds behind the industrial and logistics sector that only grew.
Yeah.
Why did you cash it in?
It actually ties into your earlier question about transactions and what you were doing and who you had contact with. It was a combination of the markets had really started to recover, and those tailwinds that have become apparent to everyone now weren't quite as obvious, but for those really already in it, it was. Two, some frustrations with how the market was operating then, and some of the gaps in participation, both from an occupier perspective and a capital perspective, and I'll come back to that also kind of provided a potential opportunity. Timing, being approached by Christoph at the right moment. But coming back to transactions, a large part of it was volume sales, bit of buying. One of the areas I tried to spend more personal time in and differentiate myself from just pure sales brokerage within CBRE was in the development funding space. So we were funding small private developers with institutional capital. And I won't mention names, but some quite leading figures were using Simon Blake and those kind of senior team, but more often than not, it was often me that then had to do the run around with the capital. So I was in those types of funding business discussions rather than just selling portfolios. So you get a proper look under the bonnet of what's going on with developers in particular, and how they want to run their lines of capital through their business and balance sheet creation and management, as opposed to just sales.
So rather than just deals and selling and getting a fee, you became almost like a trusted advisor brought in to look under the bonnet and actually get a good line what they were pitching and presenting, right?
Exactly.
And how you going to match up the capital, what the return would be.
exactly that. We would help with the pitch deck and the business plan and see how they would propose to use that strategic capital. And it was, for us, it was another route for doing large-scale funding or portfolio deals. Ultimately, it was driven by large-scale capital and fees, but that was different to just traditional buying and selling and brokerage. And there were a few other very good people in the market, like Phil Marsden, etc., who were doing those types of transactions. Still obviously do, but it just changed the nature of the work and the way people interacted and what they showed you and what you learned from it as well. So there's a bit of that. The other bit in terms of transactions is a guy I haven't mentioned so far, but Guy Frampton, who was kind of head of occupier services at the time for logistics around Europe. And that hadn't been particularly well integrated into the capital markets piece. That was always separate. You do occupiers, we do the investment, But when I was kind of more left on my own, basically at a young age, I was definitely looking around of, well, how do I make more of myself and more of this business, and having an occupier business with retained occupier customers that want developers and want build to suits and all that kind of stuff, and maybe start funding themselves. I was keen to pull on any of those experiences and work much more as a team. And I think similarly for Guy, he found a capital markets guy that basically wasn't trying to rip him off the whole time on his occupier contacts. And we worked as a real team. And as a result of his relationships where they trusted him, he could trust to wheel me in, and I could add something to that conversation, and we could all go off and be happy together rather than having a fight over who's done what. That's a long story, but at the time, he was basically retained by Amazon when they were just starting. That whole model has changed, but wow. he really was the main contact for Amazon, and he was also the main contact for DHL. So again, aside from doing volume sales, I basically became the retained capital markets guy for DHL and Amazon in that kind of late 2000s teens period. And we'd do procurement of buildings, run tenders of developers, but also how do you fund this off your own balance sheet, or how do we build some capital in a relationship to fund it on your, what vehicle can we create around it? So we were being quite creative at the time, and then whatever sales would come from it. So then going to your other question, if you put all that together, we were in an environment in 2014-15 where the capital markets were taking off, large-scale e-commerce was taking off, occupiers were bluntly getting a bit frustrated with only having 6 large development firms, all of whom were probably building themselves back up from their share prices or shareholder value going to almost pennies in the kind of 2009 and 10 place. They're very different businesses now, but they were still damaged by that. And dare I say it, we felt half asleep looking after their own portfolios. So you had occupiers looking for new pan-European ways to procure their buildings at better cost bases where we could undercut them. So you've got that in one ear. And on the other side, you've got large-scale capital coming in wanting to access that. But, the development funds of the main developers were already full, or there was a queue, or they were quite expensive on management fees, or whatever that was. And there was all sorts of capital saying they were frustrated. So you hear that on both sides, like, well, even though we might be a 1 or 2 man business, if we've got land, if we've got pre-lets, or options, if we've got pre-lets, and we can provide a cost-efficient route for capital and occupiers to meet in the middle, there's something in that. So it was no mistake. There was a lot of planning, but ultimately that's why I left CBRE, and then finding Christoph at the right moment, the right type of partner to complement each other. Whilst you go through all the machinations of, can we, should we, what's this all going to look like? Ultimately, we could see the market really clearly, and it's borne out to be true.
You touched on Christoph earlier in the conversation. Goodman, what's his background? What did he bring to the table? And what at that stage was your kind of marriage like? What did he look after? What did you look after?
Well, we had known each other for several years in our respective roles. Him with a quite senior leadership position in Goodman's structure, and me either doing sales for them or them trying to buy off us. We'd never actually done a deal directly together, but were constantly kind of comparing notes. And he always gave me quite a hard time, to be honest. And as a result, I quite liked him for it. And I think a lot of people found, maybe he probably knows this, but found that he was, pretty intense and could be quite kind of hard about things, or certainly wouldn't allow you to get away with an ill-considered answer when you're on the advisory side. And so I think it was probably quite difficult to deal with from an agency perspective. I quite liked it, and I think we kind of ended up kind of respecting each other. And when he left Goodman and was kind of umming and ahhing about his options, he was kind of precluded from starting a development business. His other background pre-Goodman, he was McKinsey, and he did a lot of logistics and DHL advisory work while at McKinsey. He also annoyingly speaks 5 languages as an engineering degree, and he's definitely the brains of the operation, I'd say. Say that. There was just a moment where he came to have a chat about, how do you see the market? What are some ideas of where I might take this? I'm locked out for a year from doing development, but I can do some other things. And in that discussion, we realised that actually we shared the same kind of view of what was happening in the market, same kind of frustrations, the same kind of sense of the occupiers. And Goodman had done 9 out of 10 of Amazon's first development projects in Europe and certainly in Germany. And he was head of Germany and head of development, or number 2 in the Goodman structure. So he was right in with all of that. So in that year that he was locked out from doing anything else, he went and became a consultant directly for Amazon and delivered 4 or 5 more buildings in Central Europe, working for them as a consultant, managing the developers and the contractors with the developers. And we continued to share notes, and we were like, right, well, when you've come to doing the end of that, let's kind of join forces and see what we can create together.
What was the personal cost at that stage? You said you were 34. What was the personal cost in terms of walking away and then kind of setting up the business?
Well, again, pretty big. Well, massive, actually. There's the pure financial, what you're kind of on in your market position, the market's going somewhere. There's also, if you don't jump off then, there's never a good time to go. And if the market is really going in that direction, that kind of, opportunity cost is only going to get worse. So I had in the back of my mind that there's never a good time to remove the financial support if you're ever going to do it. There's quite a lot of reputational stuff as well. So I went from the European agency market, very competitive. Unlike the UK market and other markets, it doesn't share information. You don't have all the agents getting together. You're very much competitors. So if you come out of that agency role, all the agents that you might want to deal with around Europe as a principal and as an investor and as a developer, basically you've spent the last 10 years kind of competing against them. They don't really like you very much. so you for me, there was definitely a kind of psychological, okay, I now need something from all these guys I've been competing against. And similarly,
I've been smashing out of the park.
Well, yeah. I mean, yeah, it's not making their life harder anyway, probably. And similarly, all your greatest relationships and developers and investors, you've basically said, I'm now going to take you on. And so they don't like you very much either, bluntly. And that's quite a kind of, that's quite a big psychological step. I kind of knew that was coming, but the degree to which it happens is massive. And particularly when you're not joining some other organisation. You are starting from nothing with one other bloke and just saying we're going to go and do this, and you can see people slowly kind of shutting the doors because a lot of people don't want to see you be successful at that moment. That includes some people that you used to work with as well, because basically you're opening your departure is seeing other people's careers excel. So luckily I didn't upset too many people on the way out or on the way through. So eventually people kind of softened a bit and were like, okay, well, you know, you can come back into the club, and you're proving to be kind of useful and effective in the roads that you're taking. So I think we've kind of clawed our way back out of that particular kind of lonely abyss for the first couple of years. But it's definitely a head spin from being in a top position within somewhere like CBRE. And then the financial side is, well, you go from, you know, everything that you see the big agency guys with to zero and costs going out, and you just don't know if you're going to pull off your first deal or your first development or where it's going to come from. So you have to be ready for that and have a bit of metal about you, and really want it.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People, Property, Place podcast, and that one small action really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. There's more than a couple of ways of setting up a business. You know, one way is phone, laptop, a couple of guys in a room, self-funded, let's go. Another is, you know, get some capital, working capital into the business, maybe piggyback on existing infrastructure, back office function, brand, and go. What did you decide to do, and how did you get the business off the ground?
I smile because listening to all the other options of or range of things you can do. I mean, it's infinite, really. But looking back on it, and still now, I think it's one of the things I'm probably most proud of, and is less obvious when you're doing the kind of corporate interviews or put your corporate stuff out. I think I genuinely believe we just did it the hardest way possible. We are still 100% privately owned by the partners of LCP. There's no external capital in our business. We've repaid all of that. No external shareholding. We didn't join another business. We had no support and infrastructure. We didn't have pre-existing investors or capital that were going to back us. We literally went out, got a temporary office, and said we're going to be as good as we can kind of pull this together. And I think there's obviously a lot to be said in terms of speed to market and all sorts of ways that you can get backed and bought out or have minority shareholdings and from bigger known established players. And I guess we just thought, if we're going to do this, let's own it and control it and fight hard for that. And so we've done it the hard way, I think. The other part of it is, aside from just the operational bit, we needed to get capital in to actually secure land or put into projects. You know, it's very difficult as a startup unless you control something on the development side. Being backed just to do the fee development from a startup with no co-invest, not owning the land, or that kind of stuff it's very, I think very few people have really done that. And we were quite lucky. We basically took our piggy banks and kind of put it all on a land auction in the Netherlands. First deal, yeah. We optioned for about, I think it was about 300,000 or 400,000 euros. And we got control of this site in Roosendaal that we knew an occupier probably wanted to go to. And it's been a kind of quiet private bit of interest that they had. It was a major retailer. I won't mention the name, although I'm tempted to. People can probably work it out. And it probably also goes to show a bit of our entrepreneurial spirit. They invited us in, and we sold them, you know, the dream and the idea and what our capabilities were. And they said, yeah, but ultimately we already got this piece of land we quite like the look of. You are really only a two-man band, and whilst we like everything that you're saying, can you actually do this? Anyway, it's been interesting to hear how you see it and how you might price things, and maybe we'll go away and think about that. So we rang them back and said, okay, understand all that. Can you see us in 2 weeks' time, 10 days' time or something? And we've got some additional land ideas. Let's just keep exploring, you know, trying to find a way in. And Christoph, God bless him, this is in the Netherlands, got in the car, and in that 2 weeks, he went round, I don't know, and sourced 8 to a dozen other sites. From some privates, but also in particular from some municipalities. And at that time, the land market was quite quiet. People and municipalities and politicians wanted employment. They wanted logistics. They wanted to turn around and say, I've got 1,000 new jobs coming. That's me going to be re-elected. So they gave us a whole load of land that wasn't on the market that these municipalities owned. And because they didn't have every agent and a whole load of occupiers or 3PLs all banging on their door, we effectively put them all into competition with each other. So we really got great prices. They didn't get 10 calls from 10 developers, 10 agents and 10 3PLs. They got one call from us and knew that 10 of their other aldermen and municipalities were all in competition. So we got some great pricing and went back in and they looked through the book and they're like, well, this is all quite interesting, guys. This is becoming quite useful, but we still really like this other piece of land that we've kind of had our eyes on and done a bit of work on. At which point we said, well, we thought you might say that, so we went to see them as well, and they've just offered 25% discount on the price you thought you were going to get for it if you deal with us. And at that point, they kind of said, okay, all right, you go and secure the piece of land, we'll give you a shot at this. And so we put our money down, and we got a 500,000+ square foot, 50,000 square metre, 10-year pre-let that we could then turn around and go and do the development funding on. Which we then, as it happened, just to give you an illustration of how else we thought, we then optioned the land next to it. We arranged to have an extension option in there after 3 or 4 years, which they then took, but then they had to take it on the land that we had also then controlled. We then did the rebuild of the extension of another 30,000 square metres in year 4. We then did the extension, got a new 10-year re-geared lease. We then held on to that for a 5-year management period and got another promoter at the end of that. So that was a good start. That was a really good start, and it kind of informs how we go about all deals now. It's not just that one transaction, one development. Like what does it lead to next, and what's the other piece of land? What are the mechanics in there? Who are we going to sell it to that gives us the management afterwards? And it's just all constantly built. One thing always has roots to leading into the next.
It sounds like some unbelievable structuring, foresight, knowledge, and chess play as well, in terms of kind of positioning.
If you're going to do it, go and do it properly. So we also knew we couldn't do, because we were small. We knew we couldn't do vast volumes of development. So the development we do, we want to be co-invested in. We want it to be quality, and we want to retain as much control and management and onward future participation and all that kind of stuff as possible, and make the most out of the babies we create along the way. That isn't always possible, but it's been a good road. So our volume is not too bad compared to others, but I think the profitability per deal, and maybe we'll touch on that in a minute, is pretty powerful.
So that was your first deal.
That was our first.
Put everything into it.
Yeah.
I guess had to be super selective, right, in terms of what that first deal looked like. But it's a culmination in terms of all the experience that you'd had and Christoph had had, and that clever engineering and structuring to that point.
We knew we were in and on something good. That didn't just material. That was probably one of 50 things we were spinning plates on at the time. But once we knew it had all the elements, then we were fully in on it. The flip side is the second deal we did, and maybe you're about to ask me about it, but that's also, let's say, a realisation of risk and how quickly that first deal and everything you made out of it can be taken away pretty quickly.
Development. A lot of people look at developers and they look at the massive development profit at the back end and they think, making a lot of money. But it's fraught with risk. It's fraught with challenges.
Yeah.
And especially in today's market.
Yeah. Yeah.
You look like a man who knows that and has experienced that firsthand.
Yeah. Well, risk is it's not a funny thing at all. It's a very real thing. And it's something that people talk about. I used to talk about, and I didn't really understand it until you really experience how quickly and how badly things can go wrong. And a little bit of luck means that luckily we avoided it, but I got to experience the full gambit of when things go wrong. And so just to illustrate it, and I think this is, I sometimes find it entertaining when I hear certain people or agents or advisors and even some fund managers talking about risk, and I just think you can talk about it, but you haven't actually lived. Some people just haven't lived it in the same way, and I think it would change people's perceptions and how they operate and deal with other people and be a trusted counterparty and all that stuff if they really understood it. So, for example, second transaction, I used to. I remember talking very clearly to a very senior, very well-known, very, very successful developer about risk when I was an agent. It's actually embarrassing thinking back to it. I was like, and this is when I was already thinking about something along the lines of LCP. And I was kind of challenging him, saying, when you've got these build-to-suits and, you either, you option it, you back-to-back the deal with the land, or you already own the land, you put out a development contract to a contractor, you back-to-back it, you bring some financing, what risk are you really taking? Why should you earn these profits, and why aren't you just doing it for fees and even less fee? What? And he started to get pretty pissed off bluntly with this chat from this junior agent who clearly had no idea what he was actually talking about. And I walked away, and I still remember thinking, I'm still right. I'm sure he's just being defensive, to protect his kind of position on why development is as powerful as it can be. Until we got to our second development, and after the first one had gone so well, and basically we did the same thing again, where we went and secured some land on an option. This time it was in Italy, and it was a large chunk. It was for over 1 million square foot development, with a large e-commerce operator that I won't, don't need to probably elaborate on too much. And one of the ways of arranging those contracts, they're happy for you to back-to-back the land acquisition on having a building permit and a lease, and similarly the funding that comes in, when you have the lease and the land, and you put it all together. And from the customer's perspective, they're all there to sign the lease, so long as you've got your funding, you've got your land. But they also, to get into a position where they're comfortable, want you to pay for some costs up front. If they then change their mind, and it's not because you lost the land or there's a DD or because your funding's not there, they will reimburse you those costs. And it's to get the whole thing moving on these big, complicated 1 million plus square foot projects. So we got this all lined up. We had secured the land option and land payment, which was probably, I don't know, 5 or 6 million euros to be paid, with a relatively large kind of, I don't know, €1 million deposit up front. And then we had pre-agreed some costs and some ordering of materials to get the thing moving on the basis we had our funding and a lease agreement. So there was probably, I don't know, another 5 or 6 million of concrete and steel and a bit of permitting and stuff like that, all kind of loaded up front. But all the pieces were in place. And then we were about 10 days away from signing the final lease and land purchase. Land purchase was from the Italian government.
Having fronted all this cost?
Having fronted probably half of those costs, but also an obligation for the further contingent of these deals. For the obligation, and so long as we had our funding in place, as I say, reimbursement if someone changed their mind. I definitely won't mention this investor's name, but they rang us and put us on a conference call with and we'd been on this for 6 months probably with them, put us on a conference call with that customer, said, very sorry guys, got to the last minute, I'm afraid we've changed our mind on Italy, we're not here to do that anymore, our investment committee have turned it down, thanks very much, but and you just feel the blood kind of draining. And because they'd put us on a call with the customer, we couldn't kind of challenge it, intermediate anything,
manage the situation,
it was just that's it. So we were, okay, thanks very much, good to know everyone we're all clear on what that means. We put the phone down, and my phone started buzzing immediately afterwards, and it was the customer. And they said, look, you guys have done a really good job to get it into this shape. We like everything about it, but your funding partner's just pulled out on the phone, the equity, let alone the debt. I'm afraid, without that, we can't commit everything that we need to commit to the lease and all the costs and the people and the automation and all the stuff. Really disappointing. We are going to have to pull out. By the way, we don't owe you for any of the reimbursement of any of these things because it's fallen apart because your funding's not in place.
That's on you.
Yeah,
that's
basically.
not on us.
So Christoph and I then had a quick chat, and so you go from that first deal and all those smart, manoeuvres and profitability and thinking, we can really go forward. And so the second deal, after a year of working on it, 6 months with a particular capital partner, Christoph and I owed about, 12 million euros, half of which was to the government.
Having already dropped 3 or 4.
And without without any transaction, that was it. It was gone.
There's no customer, and there was no capital.
So
behind
that could have been the end of LCP. Bluntly, at that moment. But luckily, I think there was at that point Andrea Benvenuti, our third partner, was definitely fully in the business. But I think it was the three of us and maybe Mathieu Olive, who's now a partner. And has been a partner for a while. He was our first employee, but very small team. And we it was just one of those moments of, okay, now I understand what risk is. And the only way out of that was I then had to call the head of the customer back and say, look, realise this is far from ideal, but give me 5 weeks and we will sort this out. You will get exactly the same deal. No delay on your critical path, no change in your economics. Just I need 5 weeks to sort it out. And so we went about and we went back to some guys that we kind of had looked at some of our LCP stuff and ideas at the start. And I will mention their names, but Ludovic Bonini and Remy Vertupier at AEW stepped in, and we spent 5 weeks literally sleeping in respective rooms within one lawyer's offices. Maybe not the full 5 weeks, but certainly the week at the end, and negotiated a full funding contract for 1 million square foot in 5 weeks, signed it, got it done, and everyone got what they wanted. And LCP got a second chance at life. And we treat capital and contracts and risk very differently after that.
I can only imagine. How did you go about...
Sorry, long response.
No, but I think appreciate the honesty and the transparency. I think it's... it just goes to show the chalk and cheese and, the highs and the lows and the reality of the situation as well. And I guess it also touches on the importance of your network,
trust.
The
between
trust.
counterparties, yeah.
That's capital, occupiers, and everyone between.
We often get asked what's the biggest risk in this project by capital or new capital, and Christoph and I's response is probably the capital is the biggest risk in all of it, I think, from our perspective anyway, which is interesting because they don't usually perceive it that way.
Because they say, we're here for the deal.
But until
they're actually there,
yeah,
it's not.
Yeah, and ultimately as a developer, you're problem solving all these things, which you can probably most of the time solve.
Box clever, try and mitigate risk.
But you can adjust permits, you can adjust zoning, and you can manage things. You can deal with utilities and easements and third party statutory bodies and all that stuff. Most of the time, you can work your way through that, grind that through. But if capital changes their mind, that's tough.
How did you build the business? We've spoken about a couple of the deals, the early deals. How did you build the people, the infrastructure? And I'm right in saying you've got offices in London, Belgium, Italy, the Netherlands, Spain, France, and Luxembourg. Talk to me about the kind of the European expansion importance of that as well.
We always hired after generating the business, so I think we're still quite light team-wise, people-wise, compared to the size and scale of what we do. We never hired a team and then looked to build the business afterwards. We always had business projects, land management,
revenue streams.
Yeah, or were in the midst of securing that before. That was kind of guiding principle. There's no inefficient cost or operation in the business whatsoever. Never has been, hopefully never will be. So we've always been quite lean and mean in that respect, and that stood us in good stead. We're now 45 people. I don't think we could be much lighter than we currently are. And it's a good size. And basically we do 1 or 2 projects per country, build that country team, then it could go off and start finding its own projects, have less partner influence into it, or less of Christoph and I, and then we'd go and set up the next country, go and investigate that, get our hands on the next project, often overlap with customers. We would borrow people from other teams. So Christoph and I had worked across multiple countries. Andrea had worked in Central Europe, but he'd also worked in France and Italy. Emmanuel Mercier, who's a partner of the business, worked at Amazon, was head of construction there. He'd worked in France and Spain and the UK. In fact, so had Andrea. Mathieu, who had worked at AEW, had a pan-European role before that. So we really pulled and borrowed each other's experience, and we just kind of hunted as a pack. So whenever we were doing a country project, there was always probably 1 or 2 people in country and probably another 3 who wrapped around. So it was always a 5 or 6 person team in every meeting. And it was very hard to distinguish who was on which countries. And you slowly build that up and hire people into it. But you need real diversity with what we're doing. I mean, some of my previous skills and areas of what I was involved with lend themselves to what we do now, but all the technical side and the development side, that really is outside my bit. So we knew right from the start we needed really strong technical delivery teams and people. We were quite quick to identify we wanted a really decent CFO. This wasn't a Mickey Mouse business, someone who'd run big multinational business and was used to dealing with the scale of, and could really sort that bit out. So we have great institutional reporting, credibility and business plans in that area. And then you go in each country and you try and persuade some more junior people and some senior people to come and join you. And that's probably as hard, if not harder, than finding land positions, bluntly, as a startup business. Each for different reasons, but trying to hire the right people is tricky, definitely tricky. More often than not, we're the ones being interviewed, not the other way around.
Often the way. Yeah. How difficult is it? Chicken and egg. Is it finding the land first and optioning the land, or is it talking to the capital?
It's land.
Land first.
Yeah, land. Land or occupier, operator, customer. One of those 2 things. Often it's customer relationship with them trusting us to tell us roughly where they want to be, and we can go and find some nice land options and get put into competition with others and then make a good proposal. Once you have that, you can bring in the capital. But the market's changed as well. I mean, we were, for the first 5, 6, 7 years, almost exclusively build-to-suits. That's land and customer driven. And then to be able to compete at scale, it's much harder to option land now than it was. Way more politics around it and difficulties with utilities and all the rest of it. So building a land bank that you can control and getting a bit more spec then requires capital to back you. So we're a bit more balanced. We're about 50-50 now. And then, in this new part of the cycle, again, it's really, really chicken and egg. I think the difference to now from before in this part of the challenging cycle, the stock market's changed, values have fallen. I think there's still repricing going on personally, although some people are talking about green shoots, remains to be seen. The logistics has had such strong investment. They're much bigger, much better capitalized, multitude of platforms out there that can kind of see their way through, and also whose balance sheets haven't been injured in the same way. And I suspect some of them are going to be able to take real advantage in this next part of the market. Some will get a bit tripped up, but some of those big guys who are around in 12 and 13 or went through the previous cycle, much stronger positions. So we can't pull the same trick as we did before, and we know that, but we maybe don't need to in the same way. So,
can you give me a bit of an overview of the business today, just in terms of assets under management and also what your development pipeline looks like in terms of numbers?
Yes, we developed over the 9 years to date about 1.4 million square meters. So what's that? 15 million square feet, roughly, of which about 10 or 11 of that was in the last 5 years. So obviously a slower build up to start with. And that translates to values of probably 350 million in the first 5 years, and then $1 billion of GAV in the last 5 years, all of which we sold. So that was traded through the cycle. So one of the things that, again, thinking about risk, that we kind of find frustrating and entertaining in equal measure is development businesses are seen as risk, kind of intrinsically risky. But we don't get it, because you're only ever exposed to the market cycle for the period of that development, and probably the period that you're actually drawing funds, and not even the kind of 12, 24, however long the lead in, until you start drawing capital to completion or sale. Your exposure is that 12, 18-month period, and you can choose to sell it early. So you can pick to only be exposed to capital markets, take your price, take your full profit with actually a 6-month exposure as you go through a cycle. So we would prefer to do that, and we'd prefer to do 100 million development for the equivalent of managing €1 billion of assets under management. So for every 100 we develop, somebody else has got to be managing roughly $1 billion to get the same kind of economics. And that's assuming they time their exit after 5 years at the perfect point and they're able to crystallize all their carries and promotes and all the rest of it. We chopped ours the whole way through. So when something like the last 12 months happens, you don't get caught out in the same way. And that wasn't luck, that was judgment. You know, we got told the whole way through, why aren't you aggregating and all that stuff? And, you know, you could build, you know, why aren't you holding this and bringing capital into that? Well, one, it becomes a distraction from the really powerful part of the profit and value creation of the development, if you're distracted going off and doing other things potentially. And two, if you don't time that precisely, you know, we could have worked for 9 years and been caught out by the interest rate hiking cycle, and suddenly your €1 billion portfolio is worth a lot less than that, and there's nothing in it for you. So, and also the capital that invests with you. So, you know, we were lucky in terms of timing of the upcycle. We were lucky that we did all our equity and senior debt repayment in December last year, and we were only left with a very small amount of assets to sell, and we did 350, 400 million of sales in December, use that to repay. So to put some other metrics on it, for example, within 5 years, we started our, we got an equity injection and did an equity raise in 2018, which we managed ourselves, and we selected Invesco, and it was a private equity US value add fund base, so not the guys you necessarily know over here or around Europe. And we took a pref equity facility onto our balance sheet, so it wasn't deal by deal. We drew it, it came on, we paid it a coupon, and it was effectively a cheap source of equity, but an expensive piece of debt. And it gave us a lot of control over the business. Their money washed in with our money. It wasn't on a project by project. So as we were recycling, we're just building the balance sheet of our business and managing that. And I think, you know, peak balance sheet was, I don't know, 450 million or something like that. We've done all those repayments. You know, we've now got we've got no senior debt, or very modest senior debt, a little bit of corporate line, but very conservative. And we probably put, I don't know, best part of 13 million or something in 2018 between Christoph and I, and Andrea, to be fair. And we've now got a balance sheet which is independently controlled and owned by the shareholders of LCP. That's 200 million 5 years later. So it's been good. And for the investors, you know, they got a 22, 25 IRR. We returned them their 190 million facility plus an 130 million euros of profit.
Wow.
It's been good.
It's been a good few years.
Yeah.
And
we're still just a small developer, you know.
With 45 headcount.
Yeah.
What's your take on the market right now? You know, it's been a challenging couple of years. What's your view, and where do you see the opportunity?
Still trying to navigate it and make sense of it, to be honest. I think I've been through, and so the other partners and Christoph in particular, various parts of the cycle from from the early 2000s, GFC, the unwinding then the logistics boom. We've seen other sectors fall off, others have bubbled up, logistics has ridden a nice wave, and then an unexpected interest rate hiking cycle, inflation, COVID and all the rest of it, all combining, and it's definitely injured values in the whole real estate market. I've always thought that people, maybe a bit slow on the downturn and too quick to think it's all going to come back. These are much longer kind of cycles, I think, and trying to get development in particular to stack up at the moment is tricky. So it's all a challenge. And again, the whole thing is the appraisals and all the economics and the numbers have all been thrown in the air and reshuffled, and so have all the equity participants, and so have all the kind of what did create value or didn't create value for people along the way and what they're managing out or have resolved. The whole deck's been reshuffled. So that can be quite unsettling for a lot of people. It's unsettling for us to a degree, other than we kind of like that. We know that. We know what that sensation is. We've seen that. And if you've got good foundations, it just smells like opportunity, feels like opportunity at the moment, more opportunity outweighing the downside for us. But I think that's particular to the type of business we are and the position that we're in. There's definitely in the last weeks and months more trading activity in 2024, which is all good news. But it is the same type of private equity, large-scale deals, structural reasons for those deals happening. I'm talking specifically about the logistics sector. So whilst that's all positive and there is a way through and a way to price and deal with those kind of parties, particularly if they know you and like you as well, that's all great and you've got good quality kit and a bit of pipeline to go into it. I think if you're left holding assets, I think there's a longer path out for value recovery than what I see in sense people kind of reporting. And having been on the agency side of the world, everyone's motivated to get the thing wound up and cranking again. But I think it will take, I think when you've got sales in the market, and we have done, and we've got a few at the moment, the depth of the market is really shallow. It's still really shallow. And I think it will remain like that. And if you've got something that doesn't quite fit that pool of buyers, you're then a long way off. And there's probably way more silently unsold things going on and happening than what you see in the press. That's just a tiny sliver of the success at the top. There's loads of stuff that's just kind of having quiet conversations and just park it quietly back on the shelf and and leave it. So I think that's something people should be a bit more wary of. Maybe they are, but not to get kind of carried away with green shoots and 25, 50 bips on Fed rates or central bank rates isn't going to be quite the solve-all yet. I think it's got further to go. And on the downside, not to be the kind of total bearer of doom and gloom, because usually I'm the eternal optimist, but there is a massive amount of debt still to unwind, and that's a debt wall that's leverage that was taken over the last 5 years, or within the last 5 years, that needs to come to maturity and was off, 1.5%, 2% maybe total cost, let alone margin, that needs to go to 4, 5 cost with margin on top potentially. And that wall of maturities doesn't even peak until something like 2027. There's 185 billion of debt maturity in the European markets that's going to go from that cost to that. And that is not discussed enough, and that has only really just started. And I think you could end up with people having to effectively pay the banks by putting in more equity and higher costs to effectively hold their portfolios or assets or completed development stock, and then they hope within a year or 12 months or 24 months that capital markets come back and they can kind of squeak it away. And I know, because until we did our sales and our repayments and all the rest of it, we're looking at that when we manage a balance sheet. So no one's ever going to talk about it openly, but we know it's there. And we've got lots of capital and we'll be happy to take it off your hands and solve some of it over the next couple of years.
Yeah, and I was going to say, I guess you can sit on a balance sheet of 200 million quid. You can be a bit smarter. You can time the market, and you can be more sophisticated in terms of when you need to go. You're not under pressure to have to make decisions for fees or for need of looking busy. And that probably leads us on quite nicely in terms of the opportunity set. It was announced recently that you're going to be launching an investment management business, Logistics Capital Partners IM.
Yeah.
Not the only one doing it. Panettone, you're doing something similar. Chancery Gate, Firethorn. Why now? And what's the rationale behind launching an investment management business?
It wasn't timed particularly for this part of the cycle, I would say, and it certainly wasn't timed around what anybody else may not be doing. That's all just coincidence. And it probably sounds a bit more grand than at least how I'm going to describe it now than it really is. We have a regulated capability now that we can offer capital that additional service, I guess, and that's for tax efficient equity investing around Europe, and we can passport that into different countries. And we've seen how would I describe it, groups that don't necessarily develop or produce a stock, groups that don't necessarily really do the fundraising or aren't really the equity, I need to be careful what I say, but aren't really the equity behind it, provide investment management services, but are a bit of a postbox between all of it on relatively high fees, but it provides a regulated status and a tax efficiency, and it provides a service that some of those investors that aren't necessarily domiciled there need. And we've had some of that in the structures that we do the asset management for. I didn't mention inside from all that development business. At peak we had over $1 billion of assets under management as well. Typically we sell and often end up managing things, along with our management at Tritax Eurobox's fund, where we're the largest asset manager. And so when you see those layers of investment management built into some of these structures, we just look at that and think, well, why aren't we providing the one-stop shop? We're producing half the stuff that the end capital is buying. We are doing basically the local accounting and all the technical review and compliance and governance and all that stuff. We really should just go and get our accreditation. So at the moment, it's not with a view to going and raising a blind pool and having a blue chip investment management house. That is not what we're doing, but it is to provide capital partners that are interested in what we do and development, and then more efficient holding structures in country with a one-stop shop as a very good place to start. And I think that's got a little bit of traction because a lot of equity and managers, want more efficient holding structures ultimately, and we can do that for them. So it's just good timing, I guess. And then in this brave new world that we're in,
there are a number of people setting up new businesses right now across a wide range of sectors, a lot of them development-focused businesses. Yeah. What advice would you give to someone who's earlier on in the journey, who's just setting up or about to set up a new development platform?
Don't do it.
Because?
No, you can give it a crack. I think it's hard. I think it's a harder moment now than when we set up, because I think the recovery that is going to come won't kind of immediately kick in, and we were quite a long way into decent recovery, and we had a lot less competition around. People were a lot less aware of the themes and throwing not just $1 billion but multiple billions in, and conviction plays around logistics. That all came, so we had a very nice timing right. I think that is harder, and I think there's a bit more period to burn through before a proper recovery comes. So over the next 3 or 4 years, that could get quite expensive operationally if you're not straight into things. And thirdly, I think the big logistics guys that we were kind of up against for the really big profitable stuff that we got involved with are far better capitalised, more awake, and are fully kind of pumping. And they've got bond lines, bigger corporate lines of finance raised off levels that are very difficult to get near to compete with. So without, wanting to blow too much smoke up them, we fancy our chances, but only because we've done the last 9 or 10 years. That all said, it's always worth a crack, and I'll enjoy a beer with you at some point when you come and tell me if you succeeded or not.
As we draw to a close, James, the question that I ask everyone on the podcast is, if I gave you £500 million worth of capital, who are the people, what property, and which place would you look to deploy that capital?
Well, I suspect everyone says the same thing that I'm about to say, which is I would do exactly more of the same. And in that sense, we're, conviction guys. We don't have to do this if we didn't believe in it, if we didn't want to do it, if we didn't see the opportunity. And it's still there in a slightly different form at the moment. So we are planning on doing not that dissimilar number of our own capital again in this next part of the cycle. So I'm afraid the answer is more of the same.
Same people, same property, same place.
Same people. Although I probably should have mentioned it earlier, but I'd add into that data center business, and particularly for us, land promotion for data centers. I think a lot of logistics people are aware and alive, and there's an overlap there. We have bought a site which we intended for logistics that, again, we sold to a big hyperscaler at the end of last year. We're working with other hyperscalers, but basically the skills in our team to go and find a dirty piece of contaminated land that needs permitting, power reservations, substations, decontamination, and all the rest of it, before it gets to the stage where all the data center operators want it and all the private equity data center businesses want it. You need teams like us to go and dig that out of the ground, basically, and solve all those problems. And it's really complementary to what we're doing. So kind of in the background, our sale and provision of that was announced, but there is a lot more that we're working on, which will come out over the next year or two, which will be quite exciting.
Well, James, thank you so much for joining me on the podcast today, being so open, candid and honest about the realities of...
I'll probably be shot when I go back. But anyway, thank you.
No, well, I know that the listeners particularly like founders' stories, and especially ones where they can be open, transparent, and talk about their journey. And you've done that in buckets. So I'm really excited to see what you and the team go on to achieve ahead of this next cycle.
Thank you.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockbourne. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockbourne.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.